Hi everyone, I'm Basil Neelambra, tutor for Audit and Assurance at Kaplan School of Accountancy and Management, a platinum approved learning provider. In this video, I'm going to debrief audit risk question involving ratio analysis. This video will be posted in two parts. Part number one will be calculation of ratio, and part number two will be audit risk and how to link the ratios calculated into the audit risk question. So don't forget to subscribe this channel and click on the notification bar so that when I upload the second video, you will be informed. So this is AA Practice Exam 2, question number 17 from Practice Platform. So there are two questions in the question number 17. Question B, calculate 6 ratios for both years, which would assist you in planning the audit of Centipede. It's a 6-mark question. So if you scroll down the question, you'll be seeing the draft financial statement for 20x5 as well as 20x4. And the question is asking us to calculate 6 ratios. The point number one you have to remember is when you calculate the ratios, you have to show the figures in the numerator and in the denominator, as well as the final answer. So let's start with calculating the 6 ratios. The first one we'll be calculating gross profit margin. So gross profit margin is equal to gross profit divided by revenue into 100. So gross profit is equal to 9,390 divided by revenue 25,230 multiplied by 100. And in 20x4, it is equal to gross profit is equal to 7,165 divided by revenue 21,180 multiplied by 100 equal to. Now you can use your own calculator or you can use the calculator that is already there in practice platform. So 9,390 divided by 25,230 in percentage is 37.2. So 37.2 percentage. I'm just making this bold by pressing this bold B, or you can simply press Control B as well. The next ratio of gross profit previous year 20x4 is 7,165 divided by 21,180 into 100 equal to 33.8 percentage. So 33.8 percentage, making that bold, Control B. Now the next ratio would be operating profit margin. Operating profit margin. Closing this calculator. So operating profit of 20x5 is given 4487 divided by revenue 25,230 into 100. And previous year operating profit is 3,920 divided by revenue of 20x4 21,180 multiplied by 100 is equal to, again using the calculator to find out the values. So 4487 divided by 25,230 in percentage 17.78. So we can round off to 17.8 percentage, making it bold by pressing Control B. And previous year is equal to 3,920 divided by 21,180 in percentage 18.5 percentage. And again selecting it and making it bold so that we can easily compare. Now the next ratio would be inventory days. Inventory days. Inventory days equal to inventory 2,360 divided by cost of sales 15,840 multiplied by 365. And previous year inventory is equal to 1,800 divided by cost of sales 14 or 15 multiplied by 365 equal to. Now calculating the inventory days of the first year, 20x5, 2,360 divided by 15,840 multiplied by 365 equal to 54.3 days. So we can say 54 days. And previous year, inventory 1,800 divided by 14 or 15 cost of sales multiplied by 365 equal to 46.87. So we can round off to 47 days. The next ratio would be receivable days. So receivable days is equal to trade receivables 1,590 divided by revenue 25,230 multiplied by 365. And previous year receivable is 1,250 divided by 21,180 revenue multiplied by 365 equal to. Now again use your calculators to calculate this. So receivable days 1,590 divided by 25,230 multiplied by 365. That is equal to 23 days. And previous year 1,250 divided by 21,180 multiplied by 365 days equal to 21.5. We can round off to 22 days. Payable days, the next one. Payable days, the formula is trade payables divided by cost of sales. Trade payable is 3,500 divided by cost of sales 15,840 multiplied by 365. And previous year trade payable is 2,800 divided by cost of sales 14 or 15 multiplied by 365 equal to. So payable days, you can use your calculator to find out the payable days. 3,500 divided by cost of sales 15,840 multiplied by 365. 80.65, we can round off to 81 days. And the previous year equal to 2,800 divided by 14 or 15 multiplied by 365. 72.92 days, that is equal to 73 days. Now, the last ratio, current ratio. Current ratio is current asset divided by current liability. And don't forget to show what are you taking in the current asset. So 20x5 current asset would be inventory 2,360 plus trade receivables 1,590 divided by current liability trade payable 3,500 plus overdraft 900. And in previous year inventory 1,800 plus trade receivables 1,250 plus cash, which is also current asset 480 divided by trade payables 2,800. So this is equal to 2,360 inventory plus 1,590 receivable is equal to 3,950. That is current asset divided by 3,500 plus 900. Current liability will be 4,400 3,500. There's a small mistake. Trade payable 3,500 plus overdraft is equal to 580. 580. So that would be 4,080. And previous year equal to 1,800 inventory plus 1,250 plus 480, that is equal to 3,530 divided by 2,800. So 3,580 divided by 2,800. The previous year equal to 1.26. So that would be 1.26 is to 1. And current year 3,950 divided by 4,080 is equal to 0.968. So we can round off to 0.97 is to 1. So that's it. We have calculated 6 ratios. So in the next video, I'll be explaining the C part of the question from a review of the background and planning meeting notes and the ratios calculated describes 7 audit risk. I'll be uploading in the next video. So please do subscribe to this channel and don't forget to click on the notification bar so that you will be knowing when I post it.